Hi, this is Dan Smith of DPS Legal Counsel, and welcome to today's video and podcast episode of Legal Scrubs. Today I want to talk to physicians who are either considering selling their practice or a physician who is considering buying a practice from an existing and retiring physician. And what I want to talk about are the two main types of sale transactions that you'll see when a doctor either sells or buys a practice. And those two main types of transactions are either a stock purchase or an asset purchase. A stock purchase is essentially where a doctor who is selling his or her practice sells the business stock itself. So for example, if you operate as a professional corporation, you would sell the shares of your professional corporation. You basically sell the corporation itself. That's a stock sale. Now, if you operated as an LLC, as a professional limited liability company, a PLLC, you would be basically selling not your stock, because you don't have stock, it's not a corporation. You would be selling your membership interest in the PLLC. Basically still selling the entity itself rather than the underlying assets of the business or the practice. Now, an asset sale, on the other hand, is where the selling doctor is selling specific assets of the practice rather than the practice itself, rather than the shares in the business itself, rather than the shares in the corporation or the membership interest in the PLLC itself. Typically, the sale of assets includes substantially all the assets of the practice: fixtures, furniture, and equipment. It may include accounts receivable, or it may not. And it may include some value given to intangible assets or goodwill of the practice. In fact, most cases it would include a number or value for an intangible piece of the practice or goodwill over and above values of the hard assets like the equipment and furniture. So why would you choose to do either a stock purchase or an asset purchase? Well, typically the seller and the buyer may have conflicting views about which one they want to do. Sellers typically want to do a stock sale. The reason being that it allows the seller simply to just, once the sale is done, to walk away, and the buyer has essentially assumed all the liabilities of the practice. Anything that comes in as a liability of the practice, because the buyer has bought the entire entity itself, would be the buyer's issue. Also, a sale of stock, corporate stock, is a capital gains transaction, and so typically the seller is going to have a good tax consequence from selling stock as opposed to assets. Now, the buyer, on the other hand, would typically want to do an asset purchase. The reason being that the buyer typically doesn't want to take on unknown liabilities of the entity itself that it's buying, the unknown liabilities of the practice that it is buying. And so rather than buying the corporate shares or the membership interest in the LLC, it simply buys the assets, the hard and intangible assets of the practice. And in addition, this allows the buyer sometimes to get a beneficial tax treatment, because if they can allocate enough value to certain assets that are depreciable, then they may be able to get some depreciation deductions with respect to those depreciable assets over and above what the situation would be if they bought stock in the entity. So with tax issues, you have to look very closely, and it's not something you can really give blanket statements about. You have to look at the specific case of each practice and determine what the tax consequences might be for a stock sale versus an asset sale. So I don't want to say that one's always better than the other from a tax perspective, but those are just generalizations I'm throwing out there that you have to be aware of. And in any particular case, you're going to want to look and see what the tax ramifications would be for the seller and the buyer with respect to either a stock sale or an asset sale. But the general rule is that with a stock sale, you do have the seller being able to kind of walk away from the liabilities of the practice. And on the flip side, sometimes a buyer would like to do a stock sale because if there are contracts in place with respect to the practice that are assignable, payer contracts or some other types of contracts with vendors or equipment makers, equipment leases, if those contracts are assignable, then the buyer just steps into the shoes of the seller and has those contracts in place. Now you have to look at specific contracts to see if they're assignable, because not all contracts are, and so you have to make sure they are assignable. If they're not assignable, part of the due diligence and part of the transaction of buying and selling a practice is to get consents for contracts that you want to take on as the buyer. You have to get consents of the other contracting party to the assignment of those contracts. Just a lot of moving parts with a transaction, of course. So that's just something to keep in mind. Anyway, that's sort of the transaction 101 details for today, where you can see what the differences are between a stock purchase and an asset purchase. It's always going to be advantageous for both parties to look at the specifics of their deal and see which way makes more sense to them, a stock sale or an asset purchase sale. It typically is going to be one side's going to favor one side's going to favor the other. So it's all part of negotiation to see which one you end up with. And sometimes it's the decision on either going with a stock sale or an asset sale, the compromise involved in agreeing on which form of transaction it's going to be will probably involve some negotiation about how that impacts the purchase price. So for example, one party might be willing to sell the practice for X amount if it's done as a stock sale, but only Y amount, which might be less if an asset sale is done. Just different things of that sort. So all in all, people who are either buying a practice or selling a practice, doctors who are buying or selling a practice, need to be aware that there are differences in how the deal is structured, either an asset sale or a stock sale, and some of the issues involved in determining which way you go. So I hope this helps just as a general primer on the difference between an asset purchase and a stock purchase. If you have any questions, please feel free to reach out, and I'd be glad to talk to you. Thanks.